So, welcome back to the second part of our introduction podcast, which will be devoted to some of the major trends. Recent data shows that the gross flow by country, and it reveals that 4 countries in Africa have received 83% of the funds invested in sub-Saharan Africa over the last 6 years. It's not surprising that Nigeria and South Africa are the largest recipients of private equity funds, as they are the largest economies in Africa, as we talked about during the first part. South Africa in particular is a richer country with a well-developed economy and a private sector. A few of the transactions in South Africa in the data were actually investments into South African private equity firms. It's also noteworthy that Tanzania and Kenya of the Silicon Savannah both had total transaction totaling about more than $1 billion. These countries and Nigeria are attracting private equity investors from Silicon Valley and other parts of the world interested in supporting tech startups. After the top 4, we see a bit of a drop to Ethiopia, Senegal and Ghana. And no country after Uganda registers even 0.5% of flow. The total of all 18 other countries recording transaction stands at 2.2%. Controlling for the size of the economy, and you get a slightly different picture. South Africa and Nigeria drop behind Kenya, Tanzania, Sierra Leone, Liberia, Togo, Senegal and Ethiopia. Another 10 countries have also managed to attract investments over the 6-year period, totaling greater than 1% of their 2021 GDP. Togo is a financial sector hub and the home of the West African Development Bank, BOA, as well as a major transshipment destination, but that likely doesn't provide a full explanation of its success compared to, say, nearby Ghana or Côte d'Ivoire. Colonial ties may influence this pattern as well, given that 7 of the 9 countries with investment over 5% of GDP are Anglophone, and English is the language of the private equity community. In addition to the country characteristics, herd behavior among investors may account for a significant share of the concentration that these data sets actually reveal. Okay, moving on. So in terms of Africa's Big 4, South Africa, Kenya, Nigeria and Egypt, they all saw a significant year-on-year decline in the numbers of more than $1 million deal size recorded between January and April 2003 when compared to the number of deals closed in the same period in 2022. In fact, the decline in the number of plus $1 million deal sizes recorded in the Big 4 from January-April 2003 versus January-April 2022. If you look at each of the countries, South Africa, the year-on-year fall was 15%, Kenya it was minus 45%, Nigeria minus 61%, and Egypt minus 4.8% on a year-to-year basis. So, as many of you are aware, fundraising experienced a significant slowdown in the second half of 2022. This trend continued into 2023, as we saw in the case of Africa, with global fundraising for venture capital funds dropping 49% year-on-year, according to a new Pittsburgh report. Since then, fundraising level has remained steady, albeit at lower levels, as limited partners have decreased new commitments into the asset class. Again, what are some of the key trends when it comes to the state of private markets in the first quarter of 2024? So if you look at the data provided by Carta, That data shows that the startup fundraising market got off to a cautious start in 2024. The Carter aggregate data set can help both investors and founders understand the market more clearly to make data-driven decisions for their funds and companies. The quarterly fundraising numbers for 2023 ended up looking fairly similar to 2018, 2019 and the first half of 2020. In terms of the number of deals and cash raised, this looks more and more like the pandemic bull market will go down as an anomalous stretch in what has otherwise been a fairly steady market. After apparently reaching a plateau during 2023, the rate of down runs experienced another notable increase during the first quarter of 2024, jumping to 23%. The median time between startup rounds is roughly 2 to 3 years, depending on the stage. This timeline means that many companies raising new funding in the first quarter would last raise funding sometime in 2021, when valuation was soaring across the venture landscape. Considering how valuation have declined in time since, it makes sense that down runs are still prevalent. Let me explain. A down run refers to a private company offering additional shares for sale at a lower price than had been sold for in the previous financing round. Simply put, more capital is needed and the company discovers that its valuation is lower than it was prior to the previous round of financing. This discovery forces them to sell their capital stock at a lower price per share. For early stage investors, Q1 was the lowest or the slowest quarter in many years. Seed deal count fell to 414, down 33% from Q4 in 2023. And Series A deal count dropped to 313, a 36% decline. In both cases, those are the lowest quarterly deal counts since at least the start of 2019. Total cash raised also declined at both stages in the first quarter. The 3.1 billion US dollars in Series A cash raised in Q1 represent a 35% decline quarter over quarter and a 34% dip year over year. Cash raised at the C stage declined by 33%, both quarter over quarter and year over year, as I hope you can see on the screen. It was a much friendlier fundraising quarter for companies in the middle stages of the startup life cycle. The number of Series A deals in the Q1 declined by a modest 11% compared to the prior quarter, and Series C deal count increased by 14%, marking the busiest quarter that stage since Q2 2003. Total cash raise also rose significantly in Series C in Q1, hitting 4.6 billion US dollars. That's a 130% increase quarter over quarter and a 44% bump year over year. At Series B, total cash raised has now increased in consecutive quarters. The rate of new venture rounds involving liquidation preferences multipliers and cumulative dividends both increased in Q1, with the 8% rate for liquidation preferences over 1x tying a recent high. Let me explain. Startups are hazardous investment because they fail so frequently. A liquidation preference is one method that VCs might defend themselves from downside risk. A negotiation clause known as the liquidation preference grants an investor preferential rewards in the event that the firm is sold or goes through another type of the so-called liquidity event. Liquidation preferences can affect how exit returns are allocated. Thus, it's crucial for venture capitalists and founders to understand them. It may affect the founder's capacity to draw in new investors and talent for the business. Liquidation preferences is the second most important factor for venture capital investors. The first is a company's pre-money valuation. Liquidation preference is important because it determines who gets paid first and how much. It applies to startup companies choosing to sell, going bankrupt, or going through other liquidation events. What are typical terms of liquidation preferences? You have the multiplier. The liquidation preference is typically expressed in terms of a multiple of the original issue price for a series of preferred stock. The multiplier is often 1x, though it can be higher depending on the risk involved with the investment. In other words, these sorts of structured deal terms are designed to provide downside protection for investors, increase the likelihood of a positive return. When these terms become more common, it's typically a sign that investors have more leverage in deal negotiations. These structured terms had all become much more frequent in late 2022 and early 2023, only for them to grow less frequent in the past 2 quarters. In Q1, the trend shifted again. At the seed stage, Series A and Series B medium valuation have been much more resilient than deal count over the past 2+ years. At seed, for instance, the median pre-money valuation declined just 0.2% between Q1 2022 and Q1 2024, while the deal count fell by 43.5% over the same time span. At the latter stages, however, the trend is reversed. At Series C and Series D, round counts have been more resilient than valuations. The medium Series D valuation dropped by 71.8% from Q1 in 2022 to Q1 in 2024, compared to a 50.9% decline for Series deal count. Over the past 2+ years, median valuation have mostly moved in tandem with medium's cash raised. At the seed stage, the median valuation was down 0.2% from Q1 2022 to Q1 2024. And median cash raise was down 7.1%. The gap was even closer at Series D, where the median valuation fell by 71.8% over that span, and median cash raise decreased 68.6%. The scale of decline in median valuation since the start of 2022 also correlate with the venture timelines, in the sense that the later stage, the later the stage, the larger the decline. The same is true of cash raised, with one exception. Medium round size has declined more at Series A than Series B. While the median valuation for primary seed valuation stayed flat in Q1 at $12.8 million, the median valuation on bridge rounds raised by seed stage companies climbed to $20 million, tying its highest point since the start of 2020. This increase in bridge valuation was concurrent with an increase in the frequency of bridge rounds at the seed stage. About 42% of all rounds raised by seed stage companies in Q1 were bridge deals. The combination of bridge rounds and higher bridge valuation suggests an increasing number of mature seed stage companies that are able to garner attractive valuation and have been opting for bridge rounds rather than new price rounds. Let me explain. A bridge round is an interim funding solution for startups seeking a financial lifeline between major funding rounds. It acts as a bridge connecting the current funding stage to the anticipated larger funding event on the time horizon. In a price round, a startup sells equity at an agreed valuation to the investors. That is, the startup sells shares at a set price. For example, a startup might sell shares at a price of $1 per share. if an investor invests $1 million in the round, the investor would own 1 million shares in a startup company. Just like the seed stage, the median valuation on primary Series A rounds held steady in Q1, while the median Series A bridge valuation took a significant leap. Q1 median Series A bridge valuation of $52.1 million was the second highest figure so far this decade. From Q1 2023 to Q1 2024, the number of Series A investment fell by 26%, while the median primary valuation increased by 19%. Fewer Series A rounds have been taking place, but those companies that are able to successfully raise have seen their valuation rise. Let me explain the term valuation bridge or value bridge creation. This is a waterfall style chart that represents the value created in a fund or individual portfolio company across key equity growth areas. This generally includes revenue growth, earning before interest, taxation, depreciation, the EBITDA, margin improvement, and debt reduction. Moving from left to right, the cascading bars clearly demonstrate how each equity growth area has contributed to or detracted from the overall portfolio growth of fund or portfolio company from the entry to the exit. Series B valuation have bounced back in a major way over the past 2 quarters. The median valuation in primary Series B round jumped 33% between Q3 and Q4, and then rose another 15% in Q1. All told, the median primary valuation increased by 52% in from Q3 to Q1, rising from $77.7 million to $118.4 million. The median bridge valuation at Series B was also on the rise in Q1, climbing to $105.8 million, up to 28% from the previous quarter. In terms of percentage gain, that's the largest increase in Series B bridge valuation in more than 2 years. Median dilution in venture rounds declined in Q1 at every stage from seed to Series C. At both seed and Series A, however, the Q1 declines were slight. The median dilution dipped from 20.8% to 20.5% at seed, and from 20.3% to 20.1% at Series A. When dilution is lower, it means that founders are selling off a smaller percentage of their company's equity in new funding rounds. The trend of Series D, meanwhile, is moving in the opposite direction with back-to-back quarterly increases in median dilution. In Q1 figure, the Q1 figure for median dilution was nearly higher at Series D than at Series C, which has only happened once in the past 5 years. Let me explain what equity dilution is. So equity dilution is defined as a decrease in equity ownership for existing shareholders that occurs when a founder or when a company issues new shares. Typically, a founder starts out owning 100% of the company, and every time capital is raised or shares are issued, that ownership stake is reduced. And this is why equity dilution is sometimes called founder dilution. Bridge rounds remain a popular fundraising option for founders at every stage of the startup lifecycle. But they are particularly popular at the early stages. In Q1, about 42% of all round raised by the seed stage companies were bridge rounds. And 43% of Series A deals were bridge rounds, the second highest rate since the start of 2021. The frequency of bridge rounds also spiked at Series D in Q1, climbing to 26%. This increase in Series D bridge rounds could help explain the decrease in primary Series D rounds that also occurred in Q1. Okay, and the last slides from the trend from the Carter data basically look at the median time between rounds rose in Q1 across early stages. So with fewer transactions taking place, founders are having to wait longer between the bites at the fundraising apple. Startups that raised a primary Series A round in Q1 had waited a median of 766 days in Q1. Days since their seed round, the longest interval of any quarter since the start of 2019. The company raising a Series B, the median interval between rounds is 824 days. Also the longest it's been in the past 5 years. For founders, more time between rounds means more runway is required. So the 824-day wait at Series B represent about 9 quarters. The median time between a Series A and Series B was just 560 days. That's a difference of 264 days, or roughly 3 quarters. This means that a startup that raised a Series B round in Q1 might have needed 3 more months of runway than the data would have indicated when the startup raised its Series A. Let me quickly explain what does runway mean in finance. Runway is the amount of time in months a business has before it runs out of cash. So in other words, make sure to raise enough to get you to the next startup funding round without giving up too much of your company. A typical range is somewhere between 12 and 18 months. There are significant differences in the amounts raised by companies at this stage, but expect rounds to range from $50,000 all the way up to $2 million. Okay, so on this background, let's move on to the time to accelerate capital mobilization for the SDGs in emerging markets. So on this OECD background, in respectively the EU and the DACH region where I'm based and the US, how to increase private equity investment to meet the sustainable development goals in emerging markets. Yesterday I attended the Global Steering Group for Impact Investing's webinar where one of the GSG authors presented the findings and recommendations from the Impact Task Force publication State of Play 2023 and the GSG Impact Input Paper Time to Accelerate Capital Mobilization of the SDGs in Emerging Markets. Along with updates on local vehicle design initiative led by the GSG National Partners, the so-called National Advisory Board for Impact Investing that I referred to during the first part of today's webinar, or today's podcast I should say, in Ghana, the NAPs in Ghana, in Nigeria and Zambia. The event also served as a formal kickoff of the GSG Impact DFI co-led working group on capital mobilization for SMEs in emerging markets. So our hope with our podcast series will be that the series will be considered as a useful resource that will provide valuable inputs into the reflection of this working group on capital mobilization from the global north towards the impact investing opportunities in the global south, which is the overall ambition of our podcast series, and also included in the kind of work that I'm doing within the Swiss Impact Investing Association. And if I get selected, my work will also be included in the Swiss National Advisory Board for Impact Investing, which will be launched at the Building Bridges in December later this year. So some of the key findings of the GSC reports are that the COVID-19 pandemic has widened the financing gap to meet the SDGs. Also, with the world also off target to meet the 1.5 Celsius temperature increase goal laid out by the 2015 Paris Agreement. An estimated 40 to 16 trillion US dollars is needed over the next 5 years alone to address pressing environmental and social challenges. Renewed market volatility and rising interest rates have put pressure on investor appetite for emerging market assets, meaning that international investment is failing to reach the geographies that need it the most. Only 30% of global finance is going to emerging markets. Private finance to emerging markets, excluding China, is estimated to have declined by 22% from 2021 to 2022. DFIs and multilateral development banks' mandate and investment practices are evolving but have been slow to mobilize private capital through appropriate investment opportunities. In 2021, their effort only mobilized 40 billion US dollars of private investment in emerging markets, down from prior years. So with less than $1 of private capital mobilized for every dollar invested by DFIs and multilateral development banks, these institutions are under increasing pressure, and rightly so, by the G7, the G20, as well as emerging market policymakers, think tanks, and other actors to mobilize significantly more private capital to deliver higher development impact. Moving on, this week another report was launched entitled the Startup Insider Investor Report. That's German for investor report. So the content of this report is looking at the content of the VC landscape. So if you missed it, check out our LinkedIn website, where I've added a link to that report that will allow you to access this very comprehensive overview of the 2023-2024 VC landscape. This essential report features profiles of over 100 active venture capital funds from Germany, Austria, and my host country, Switzerland, looking at industry giants like Creatum and Cavalry Ventures to newcomers such as Nucleus Capital. The report dives into detailed insight on deal activities, investment focus, and exclusive interviews with top general partners discussing their strategies and support for startups. So whether you're seeking funding or scouting the latest trends, this report is indispensable for anyone involved in the VC ecosystem. So according to this recently published 2023 State of Venture report, in 2023, global VC funding amounted to a total of 249 billion US dollars, which is a decrease of 42% compared to the previous year, and it's the lowest level since 2017. This is not surprising, given first of all, given the persistently high interest rate environment where we find ourselves today, particularly in the OECD countries. Geographically, the regions of Latin America and Asia recorded the sharper declines, while the US remained less declining, and in 2023 raised a total of 132 billion, which was nonetheless a decrease of 36% compared to previous years, as we saw earlier. And it's worth mentioning that capital inflow into startups from the field of artificial intelligence in the US fueled the market. Financing followed in Europe the global downward trend and amounted to a total of 48.4 billion US dollars. The deal volume declined within the DACH region in the third quarter of 2023 compared to the same period last year. It fell by 46.1%, which corresponds to the broad European market trend. One thing that's different from the rest of Europe is when it comes to the deal volume, which increased since the first quarter of 2023, and the deal volume stagnated in the DACH region. By phases, that shows that the venture growth saw the sharpest decline in the deal activity